The bucket strategy sounds bulletproof until you try to actually implement it. Then you realize no one tells you the critical decisions and when to make them or break your retirement. I'm Bob Wolfe, certified financial planner and IRS enrolled agent. After helping hundreds of families navigate these exact implementation challenges, I'm going to show you exactly why this beloved strategy creates more problems than it can solve and what to do instead. Let me introduce you to Harold, not a client, but a financial planner who created this problem back in 1985. Harold Evansky introduced the bucket strategy with good intentions, but here's what he didn't anticipate. Most retirees think the bucket strategy is bulletproof. You've got your cash bucket, let's say $200,000 for a few years of expenses of $40,000 a year. Then you stack your bucket with the remaining $800,000 where stocks crash. You simply live off the cash bucket until markets recover. Sounds perfect, right? Here's where it gets dangerous. Look at these numbers. $200,000 in cash, $800,000 in stocks. That's 20% fixed income, 80% stocks. William Bengen's research on the 4% rule, the gold standard for retirement planning, whether you agree with it or not, shows you need between 50 and 75% stocks as a maximum. This setup pushes us into the danger zone. I've seen this mistake cost families financial security in retirement. When you are too aggressive and hit a 1929 style crash or 1973 to 1974 bear market with high inflation, you could run out of money by 82. Here's what shocked me when I ran the analysis. When stocks crash from $800,000 to $700,000, what should every retirement investor do? Buy more stocks, right? But the bucket strategy tells you to ignore that crashed bucket and keep spending cash. But here's the biggest problem. The bucket strategy gives you no clear rules for the decisions that matter most. Your cash bucket runs low. Do you sell bonds or stocks to refill it? Your allocation drifts to 85% stocks after a bull market. When exactly do you rebalance? The strategy is silent on these critical points. Now, as a financial advisor, I need to be honest about something. The bucket strategy is not inherently evil. It is a behavioral framework designed to help people feel comfortable in retirement. And that psychological comfort has real value. But what most people miss is that the key to any bucket strategy working is disciplined rebalancing back to your target allocations over time. Think of rebalancing like brushing and flossing your teeth. It's basic portfolio hygiene that everyone should do, but not everyone does it. And this happens a lot with the individuals that are trying to self-manage their portfolios, that I see them constantly veering off course. In my practice, I see this all the time with DIY investors. They start with great intentions, they'll rebalance quarterly, they say, but life gets busy, market's volatile, emotions kick in, and Apple's doing great, so I'm going to let that ride. 6 months later, they haven't touched their portfolio and their allocation is way off target, incurring more risk happening over time, which has a tendency to end up maximizing returns or imploding returns. The bucket strategy gives people a false sense of security. They think they can set it and forget it, living off of bucket 1, then bucket 2, then bucket 3. But without systematic rebalancing, you're not managing risk. You're creating an illusion of safety while your allocation drifts into dangerous territory over time. Now, this is where most individual investors hit a wall. Between disciplined rebalancing and proper tax location strategies, there's a lot to manage. Tax-efficient placement can significantly increase your after-tax returns by strategically spreading investments across different account types. Research shows that this strategy can boost returns on an annual basis by anywhere from 0.14% to well over 0.5%. That's an extra $20,000 to $75,000 over a decade for a $1 million portfolio. An example of this would be putting more stocks in your Roth accounts, HSA accounts, and non-retirement accounts for tax-free or tax-favorable growth. All the while keeping bonds in your traditional retirement accounts, keeping the growth in those accounts muted as well as the income tax-free. But implementing this requires ongoing spreadsheet work and maintenance as balances shift. So here's what I usually see. Individual investors might use a simple target date fund, which is easy to maintain and automatically rebalances, but they miss out on the long-term tax location benefits that could add significant value over decades. What they're focusing on is the underlying expense ratio of the fund, not the foregone tax costs that they're incurring by keeping it simple. Now, this is not just my opinion. Michael Kitces, one of the most respected financial planners and researchers in the industry, studied this extensively. His conclusion, quote, "Simple rebalancing already has an astonishing, powerful effect to avoid unfavorable liquidations." Professor Estrada's 2018 research across 21 different countries found that simple static strategies clearly outperform bucket strategies on 4 different performance measures. Larry Swedrow's analysis asked the critical question, does the bucket approach destroy wealth? And his answer, yes. Now, I understand the psychological comfort of having cash set aside and a safe war chest of funds. That feeling of security is real and important. Now, here's how to get that comfort without destroying your returns. Take a portion of your bond allocation and keep a sub-portion of expenses and high-yield savings. This could be anywhere from 6 to 12 to 24 months. You get the psychological cushion, but it's part of your overall 60-40 strategy, not a separate bucket that breaks your allocation. In my practice, I've learned that the best investment strategy is the one that you can actually stick with. If you need the cash bucket to sleep at night, fine. But make sure it's part of a disciplined rebalancing approach for good portfolio hygiene, not a substitute for proper portfolio management and regular revisiting as market winds blow and valuations change. Instead of complicated decision rules about when to move money between buckets, you have a simple rule. Rebalance annually or biannually. Put the time on the calendar. Instead of accidentally buying high and selling low emotionally, you automatically buy low and sell high instead of dangerous 80% stock allocations gliding higher and higher and higher, well above and beyond your target allocation. This approach has consistently provided better outcomes with less complexity. You sleep better knowing that you're following research-based strategies used by institutional investors and professional advisors, not marketing gimmicks. The bucket strategy tries to solve a problem that does not exist. Annual rebalancing already prevents you from selling stocks when they're down, and it does it automatically while forcing you to buy assets when they're on sale. The real issue is not the buckets themselves. It's that the strategy leaves you with unclear guidance for the decisions that actually matter. When to sell what, when to rebalance, and how much. Here's what to do. First, calculate your target asset allocation for retirement. Long-term sustainability, what are the amounts of sleep at night funds and margin for safety that we would need to have in a safe cash or bond war chest to get us through anywhere from 5 to 10 years of down markets to allow ourselves to sleep more soundly at night. Second, decide how you'll handle the ongoing rebalancing. Doing it yourself with discipline, with automatic calendar reminders, robo-advisor platforms, or professional third-party help. Third, if you are managing multiple account types, consider the tax location benefits. Try keeping a safe war chest of expenses and cash as part of your bond allocation, and make sure that we're rebalancing consistently. Remember, the strategy is only as good as your ability to implement it consistently over decades. Whether you do it yourself or get help, the key is actually doing it and doing it consistently. As a friendly reminder, this is educational content. Your situation is unique, so please discuss any major changes with a qualified advisor. And drop a comment below. Are you handling rebalancing yourself? Are you having questions of when to pull the trigger on things? Or do you think that you need help with ongoing management? And with that, thanks for watching, and I'll see you in the next video.